Good evening, everybody. On behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the today's webinar series for UPSC ICOS preparation for newly qualified cost accountants, Session 4. Session 4 is on cost concepts and classifications, cost object, cost centers, and cost unit, collection, classification, allocation of apportionment of cost, mater- material cost, employee cost, direct expenses, overhead, etc. Our today's speaker is CMA Amit Shahane, sir. He is a practicing cost accountant. I welcome, sir. He is a qualified BCom, app CMA, and CMA final. He is a director of Leverage Consultant Private Limited and practicing cost accountant from since 2010. He has corporate experience of more than 5 years, including Tata Motors, and over 20 years of post qualification experience in the field of costing, MIS, finance, accounts, and taxation. His overall teaching experience of more than 24 years. His presentations at Institute of Cost Accountants of India, Pune chapter, National Academy of Defence Financial Management, Pune, Tata Motors Limited, SME Chambers, Honeywell Turbo Technologies India Private Limited, and two various colleges and management institutes. Also, he is a corporate trainer on various subjects like a cost audit, internal audit, union budget, finance for non-finance personnel, direct tax planning. I welcome sir and all the participants for the today's webinar. Now I request sir to kindly start the section, sir.
Thank you, and first of all, thank you WRC for giving this opportunity. I was told that I am supposed to cover the basic concepts of costing, but what I have deliberately done is I have added few latest concepts in costing as well, because as I understand, all of you are qualified cost accountants. So I know that in your curriculum this is the syllabus which is prescribed, but I thought I will just cover some latest concepts as well. I'm having some issue with bandwidth, so I will keep my video off. I hope you won't mind for that. I hope the presentation is visible.
Yes, sir.
Yeah. Okay. So we'll begin with the some basic concepts or definitions. As I said at the beginning that I know all of you are qualified or most of you are qualified cost accountants. So I did not go into the details, but I just thought uh, there could be a gap in the basic concepts. So in the initial part, I'll be covering some basic concepts. I know at the cost of repetition, I'll be doing this, but since this is a part of your curriculum, I'll be taking up this. So of course, the first concept is about the cost. So what is cost? So it is basically measurement in monetary terms of the amount of resources used for the purpose of production of goods or rendering of services. So traditionally, or maybe say a few years back, say or 10, 15 years back, costing or this exercise was mainly restricted for manufacturing. But over the years, or maybe over, I would say, 2 decades, it is equally applicable to services also, or service industry is a major contributor to our economy. And cost consciousness or this all these costing concepts are equally applicable to service sector as well. So it is no longer restricted only for manufacture or production of goods, but it is applicable also to rendering of services. So both the aspects are covered over here. So whatever resources you are spending for manufacturing or rendering of services, so the measurement in the monetary terms is what is called as cost. Then the next basic concept is costing. So it is a technique and process of ascertaining the cost. Again, when I say technique and process of ascertaining the cost, it is applicable to both goods as well as for services. Then cost accounting. So costing and then cost accounting. Cost accounting compared to costing is a elaborate concept. So what it involves is basically accounting for cost classification and analysis of expenditure, as will enable the total cost of any particular unit of production to be ascertained with reasonable degree of accuracy, and at the same time to disclose exactly how such total cost is constituted. Now, the important point over here is you can see in the line number 3 that it says with reasonable degree of accuracy. What does that mean is any system, you can take any ERP system in the world, be it SAP, be it Oracle, or for that matter, any other ERP system. No system in the world can give you 100% accurate cost. And that is not what is expected also. Because the kind of energy or the kind of resources you are going to spend to arrive at 100% correct cost is much more than kind of getting the cost to the extent of say 90 or 95% accuracy. So, and of course there are certain approximations, there are certain assumptions, there are certain you can say uh, we apply certain things to arrive at correct cost, and therefore no system in the world can give you 100% accurate cost. But yes, with a reasonable degree of accuracy you should work out the cost. That is what is expected in cost accounting. And when it comes to cost accountancy, again, uh, cost accountancy is again elaborate concept as compared to cost accounting. And basically, it includes the application of costing and cost accounting principles, methods, and techniques to the science, art, and practice of cost control and ascertainment of profitability. Now, as I said, cost accountancy is a more elaborate concept, and this includes principle, methods, and techniques of costing. As you are aware that methods and techniques, there is a difference between these two. Costing methods is pertinent to a particular industry for which we are ascertaining the cost. For example, process costing, contract costing, likewise. So it depends on which industry you are working with or for which component or for which product or service you want to ascertain the cost. On the other hand, techniques of costing like marginal costing, standard costing, budgetary system, these are irrespective for which industry you are ascertaining the cost, and these are uniform for all the uh, industries. So basically, these are controlling techniques, or we can say these are basically techniques applicable for all the industries, whereas methods are specific to those particular industries for which we are working out the cost. Second most important point is it is a science as well as art. So any accounting for that matter is a science because there are certain set rules which we will have to follow. At the same time, it is an art also, and that is the reason why at the in the previous definition or previous concept also, I did explain that no system in the world can give you 100% accurate cost because to some extent it is a science and to some extent it is an art as well, and you have to apply your mind, you have to apply your own skills to arrive at the cost. So therefore this is science as well as art, and basically the final objective of this is cost control and ascertainment of profitability. And the next concept, which is more familiar or you can say more popular these days, is management accounting. So it is basically application of appropriate technique and concepts which help management in establishing plan for reasonable economic objective. So basically, in the latter side, we are going to see what is the difference between financial accounting and cost accounting. But the basic thing is management accountant or the cost and management accountant works with the management so as to enable the management to take the correct decisions in the business. And therefore, uh, our institute slogan is also behind every successful business decision, there is always a CMA. So basically, we work with management to help them to take the appropriate decisions. Then the next concept is cost object. So cost object is the technical name for a product or service, a project or department, or any activity to which cost relates. So if you want to ascertain a particular cost of a product or a service or a project or a department or any activity. So that is going to be your cost object. So basically, cost object is the object or the final outcome for which you are asserting the cost. Now, cost object can be further bifurcated into two parts. At a broader level, uh, it is called as cost center, and at a lowermost level, it is called as cost object. So what is cost center? So basically, it's a location, a person, or an item of equipment or group of them in or connected with undertaking in relation to which cost is ascertained and used for the purpose of cost control. Now, just to elaborate this point, it may happen that if you are doing a service industry costing, for example, let's say there is a hospital, or let's say there is a hotel, or and they have got multiple branches. So each branch or each location can be your cost center, and you will have to, or you can ascertain the cost for that each location. Secondly, it can be an item of equipment or it can be a group of equipments. So let's say typically the example is in case of automobile industry, if you take an example of a press shop. So in press shop, there will be various presses which are made for various applications, and this will be of various sizes and capacity in terms of tons. So if you want to ascertain the cost of a particular press, then that press itself can be your cost center. Or if there is a line of presses, which let's say that say a set of presses is performing operations from say 1 to 10. So there are 10 different presses and the product is going through all these presses, and finally after the 10th operation, or the finally when the product passes through the 10th press, finally the final product is emerged. So in that case, this set of 10 presses itself will be your cost center. So either it can be a single equipment or it can be group of equipment. Then the next concept is cost unit. So this is the lowermost level of cost object, and it is unit of product or service in relation to which cost is ascertained. So again, depending upon industry, the cost unit will differ. For example, if you take an automobile industry, then per car will be your, or a car will be your cost unit. Similarly, depending upon industry, your cost unit is going to change. Now, similar to cost center, or some you can say the advanced concept of cost center is responsibility center. Now, this responsibility center is also called as strategic business unit in terms of say SAP or the ERP softwares which are there in the market. So basically, uh, cost center, when we are saying it's a cost center, so basically they are responsible only for the cost that they are incurring. Whereas when it comes to responsibility center, they are responsible for the sale as well as cost which they are incurring. So basically it can be an responsibility, it can be a responsibility assigned to a specific person, or it can be a group of such responsibility centers. Then, similar to responsibility center, the next concept is profit center. So, profit center is again not only responsible for the cost, but it is also responsible for the profit that they are making. So, from that unit or from that center, even the sale will take place. And because of that, they are responsible for the profit that they are incurring, or profit that they are making. So, cost center, profit center, and responsibility center. These are the three terminologies, and depending upon the nature of the organization, this will be bifurcated or this will be decided based on the decision making which is expected at a management level. Right? Any doubt so far in these basic concepts or basic definitions? I expect this to be uh, interactive session so that I'll also know where exactly you are having any issues or I would like to have feedback from you also. And based on your experience also, I would like to know more. Any doubts or shall we go ahead? Okay. Then coming back to the next point, that is, what is the objective of cost accounting? So of course, the basic objective is to ascertain the cost under different situations using different techniques and systems of costing. Uh, as I said earlier, the basic objective of any cost accounting will be to ascertain the cost to the extent possible at that accurate level, and using the different techniques and systems of costing. The techniques of costing we have already discussed. Systems of costing, or you can say methods of costing, basis that you have to ascertain the cost. Then to determine the selling price under different circumstances. Now, again, this is one more objective of any cost accounting. Though costing does not directly help in determining the selling price, because as you are aware that selling price is something which is driven by the market or basically the customers. But there are many contracts which are typically cost plus contracts. So wherein whatever cost that you are incurring, on that you apply certain profit percentage, and that is how you get the final selling price. So typically this is very common in case of government contracts, or say for example the road or dam or other contracts, wherein determination of cost in advance is bit difficult, because there could be some emergencies, there could be some exigencies, there could be some surprises, and because of that, the cost may go up. And therefore, most of the government contracts are on cost plus basis or cost plus profit basis. So in that case, determining the selling price also will be a function of cost accounting. Then to determine and control efficiency by setting standards for material, labor, and overheads. Now, as I said at the beginning, that there are three basic costing techniques: marginal costing, budgetary, and standard costing. So under standard costing, for various elements of cost, that is material, labor, and overheads, the standard is set, and against the standard, the actual performance or the actual is compared, and whatever variance is there, that is ascertained, and the reasons for this variance are analyzed. So typically there will be two types of variances. One is favorable and other will be adverse. So both favorable as well as adverse variance will be evaluated, they will be analyzed, and the corrective actions will be taken. Then the next objective is to determine the value of closing inventory for preparing the financials of the concern. The inventory valuation is again one more major objective of cost accounting. As you are aware that recently under income tax also, they have made it mandatory in certain cases that if the assessing officers feel that the inventory needs to be re you can say valued, then they can appoint the cost accountants for actually valuing that inventory. And recently, the empanelment for the inventory assignments is now open by the income tax department. So again, inventory valuation is one of the major function, I would say, for cost accounting. Then, to provide a basis for operating policies, which may be determination of cost volume relationship, whether to close or operate at a loss, whether to manufacture or buy from market, whether to continue the existing method of production or to replace it by more improved method of production, etc. Now let us take one by one. Determination of cost volume relationship. Typically, as you are aware that in costing or in cost accounting, the decisions are taken based on the contribution approach. Because in costing, it is assumed that fixed costs are considered to be sunk cost or historical cost. In the latter part of the presentation, we are going to see it in detail. But just for the sake of it, just keep this in mind that fixed cost and variable cost, out of that, variable cost are also called as controllable cost. And that is something that you can really control. Whereas fixed cost, you cannot have or you don't have any control over the fixed cost. And as such, in the decision making, they don't play any role. And therefore, most of the decisions are taken basis the uh, contribution approach, or you can say the cost volume relationship. Then another important function is whether to close or operate at a loss. In the latter part, again, we are going to see the difference between financial accounting and cost accounting. But the basic objective of cost accounting is to determine whether we should continue a particular unit, or you can say a particular product or a particular service, as the case may be. Because in financial accounting, you will get to know about the overall profitability of the company. So overall, you will get to know whether the company is making profit or loss. But in costing, what we typically do is we break down that profit and loss account into product level or service level profitability. And when you do that, you get to know what exactly is the situation. And in that case, you are in a position to take better decisions that whether to continue a loss-making uh, product or service. Now, there are certain situations wherein strategically you decide that though it's a loss-making product, you will still continue to have that product portfolio with you. So there is a possibility that depending upon the stage of that product, or the stage of that product life cycle, the profitability will be determined. For example, when you introduce a product, then typically to compete with the competitors, you may have to keep the pricing at a lower level so that you can penetrate into the market, and thereby once you penetrate, thereby afterwards you can increase the prices to get the advantage. Uh, you are aware that what Reliance has done in case of, say, whether it is telecommunication or any other thing. So, for example, Jio, when they had introduced Jio in the market for the first time, for almost a year, they were offering it free of cost, or it was very at a very nominal rate, so that they could capture the market and practically they killed the competition. And later on, when they got the customer base, then they slowly started increasing the prices. So that is what is penetration pricing. And for this decision, basically you should know which product line, which service is profitable, and which product service is loss making, and whether to continue that loss making product or not. Then next is whether to continue the existing method of production. So typically, in this case or in this situation, the important decisions are, for example, you are very much labor intensive industry. So in that case, if you want to do the automation, or if you want to shift your labor intensive industry to, say, machine oriented or capital intensive industry, then for taking that decision, you should again know the cost benefit analysis. So with automation or with capital investment, how much labor you are going to save and how much is going to be the cost of that machine and related expenses. So the decision is basically whether to continue the existing method of production or you should change that method, some alternate method. And lastly, replace it, or whether to replace it by more improved method of production, and whether to manufacture or buy from the market. So whether to manufacture the product on your own or whether you should buy it from the market. So typically, if you see the way MNCs are operating in India, what they do is typically they will start with the kind of uh, semi knockdown kind of concept. That means everything will be bought in the pieces in India. in India, they will just assemble it and then they will sell it. Okay, so either CKD or SKD condition, they will bring in the material, they will assemble it and then they will sell. After that, once they get the confidence, then they will slowly start their manufacturing operations. So the classic case is of say Mercedes-Benz. So Mercedes-Benz, when they entered into Indian market, firstly they had the same concept. So since I was working with Tata Motors, they had one shed, I would say. So it was a kind of big garage. So wherein they used to bring all the parts in CKD or SKD form and they used to assemble it in that shop. Afterwards, when they had this confidence that yes, India could be a good market, then what they started was they started the painting of their Mercedes body in Tata Motors premises. So till that time, again, they did not had their separate paint shop. So they were using the facility of Tata Motors only to paint the Mercedes Benz. Then they started uh, the engine manufacturing in India. So likewise, they sorry. Likewise, they started investing on their own. So initially, everything was in the shared premises or everything was in the CKD or SKD condition. And once they got this confidence, then they built a separate plant. And now they have got a state-of-the-art facility, right from press shop, paint shop, engine manufacturing, everything they have got in their premises. But when they started with the very basic operations, or you can say very basic thing that everything was brought in CKD or SKD condition. So for all this decision making, the base is you should have a very strong costing and you should have that database with you to take the accurate decisions. So these are basically the objectives of costing. Yes. Any doubts in this? Yes. Any doubts?
Hello.
Yes, madam.
Sir, please explain cost volume relationship.
Sorry, come again.
Cost volume relationship.
Okay.
Yes.
Just give me a minute. I'm having some issue with the connectivity. I'm just trying to fix it. Just give me a minute. Uh, am I audible now?
Yes, sir.
Okay.
Yes, sir.
Okay. So basically, cost volume profit analysis is basically a financial planning tool which helps businesses to understand how change in cost, sales volume, and selling price affect their profits. So at each level of say their capacities, how it is going to affect their profitability. So that is what is cost volume profitability. So as I said, the example of Mercedes. So when a particular automobile company wants to set up their operations in India, or let's say they want to start any operations, basically the capacity that they are going to put up, or this is for any industry or for any company, that at what capacity they should start and at what level they should expand their operations. Because if I if currently I'm having a demand for let's say 10 cars per day, and if I set up a capacity of 1,000 cars per day, then obviously it will be unnecessary investment which I am putting up, and that load of 1,000 cars per day capacity will be actually loaded on those 10 cars per day which I am actually manufacturing. So in this situation, I should analyze that at what level or at what volume I should increase my capacity so that the overall profitability will be optimal. So that is basically cost volume profitability. Is that clear?
Yes, sir.
Okay. Now we'll quickly see the difference between financial accounting and cost accounting. Uh, Basically, both are the branches of accounting. So there are few similarities and there are few differences as well. Financial accounting, the basic objective is to provide the information about the business in a general way, that is profit and loss account, balance sheet of the business, to the owners and other outside partners, or you can say other stakeholders. Cost accounting, on the other hand, it provides information to the management for proper planning, operations, control, and decision making. So the basic fund, or you can say the fundamental difference is who is going to be or who are the end users of this information. So in case of financial accounting, it is more of it is more oriented towards the shareholders. It is more oriented towards the government. It is more oriented towards the uh, you can say investors. It is more oriented towards the debtors, creditors of the company. Whereas cost accounting is mainly for the management to take the appropriate decisions. We have seen in the earlier part that how it is useful for the management. Then in financial accounting, it classifies, records, and analyzes the transaction in a subjective matter that is in accordance with the nature of expenses. Whereas in cost accounting, it records the expenditure in an objective manner that is in according to the purpose for which the costs are incurred. Now, for example, again in the later part of the presentation, we are going to see, but just let's take an example that there are, say, 10 different departments in the service industry. So when it comes to accounting and when it comes to booking of a salary, then in the accounting, they will record this salary with a single entry, that is whatever salary that they are incurring, right? Now, when it comes to cost accounting, the same salary we will have to identify it department wise. So the same salary, rather than putting it or rather than recording it as a single entry, it will be bifurcated between various departments so that at the end of it, we will get to know the department wise expenses for that particular company, right? So basically, this is the fund again, the way the transaction is getting recorded. On that basis, financial accounting, it is subjective manner, whereas in cost accounting, it is objective manner. Then in financial accounting, it lays emphasis on the recording aspect without attaching any importance to the control. So again, okay, we will see the cost accounting part first, and then I'll tell you the comparison. In cost accounting, it provides a detailed system of control of material, labor, and overheads cost with the help of standard costing and budgetary control. So again, when it comes to accounting, it is simply recording that transaction as it is. But in case of cost accounting, as I said, there are three basic techniques in costing, that is marginal costing, budgetary control, and standard costing. Out of these three, budgetary control and standard costing are basically for cost control. So the earlier example which I gave, that department wise salary is getting booked under cost accounting. So the immediate next task will be to compare this salary with whatever is the budgeted salary of that department. And in case there is any variance between the budgeted and the actual, then that variance will be analyzed, that why there is an increase in the salary. Salary is just one example. This can be there for all the other cost elements like all the other cost which will be incurring. So in financial accounting, the emphasis is on the recording without controlling aspect, whereas in cost accounting, the emphasis is mainly on the controlling aspect. Then the next point is it reports operating results and financial position usually at the end of the year. Uh, of course, for some listed companies, now it is mandatory to have audited accounts on a quarterly basis. But by and large, for normal companies, this is a annual affair to publish their profit and loss account and balance sheet. Of course, again, for internal management purpose, monthly profit and loss account and balance sheet also prepared. But by and large, the profit and loss account and balance sheet is prepared at the end of the year. Whereas in case of cost accounting, you just cannot wait till the year to get over because it has to be a continuous process. And if it is not done, or if it is not done on a continuous basis, then practically it will be of no use, because once the event has occurred, and let's say, just to give an example, that let's say you are running a or you are manufacturing a product. Now it is anticipated or it was budgeted that the manufacturing cost will be, say, 50,000 rupees. Now, after the first cycle is over, you have actually calculated the cost and you have come to the conclusion that the actual cost is, say, 60,000 rupees. Now, if your cost is 60,000 rupees, then you have to take some corrective actions there itself. Otherwise, if you wait till the year to get over, practically it will not be of use because you will be incurring heavy losses. So the only you can say corrective actions that you can take is, one, to control the cost or to reduce the cost, and second, to revise your selling price. Of course, if it is in your hand. As I said, selling price is something which is that you cannot determine. It has to be, it is typically a market driven or customer driven. But yes, if you get to know that whatever you had anticipated, you are not in a position to manage within that cost, then in that case, you will have to revise your selling price, or you'll have to cut down your cost so that you will be profitable. And these decisions will have to be taken as and when desired by the management, or it has to be a continuous process. Then financial accounts are accounts of the whole business. They are independent in nature. Cost accounting is only part of the financial accounts and disclose profit or loss for each product, job, or service. Just few minutes back, I have explained that financial accounting, or your profit and loss account, basically gives the overall picture of the company as a whole. Whereas in case of costing, the cost sheet is prepared practically for each product, each job, each project, each service that you are rendering, so that individually will get to know which product, service, job, project is profitable and which is not profitable. Then financial accounts records all the commercial transactions of the business and includes all the expenses, that is manufacturing, office, selling, etc. Cost accounting relates to transactions connected with manufacturing of goods and services, means expenses which enter into production. So in financial accounting, all the expenses, practically all the expenses are recorded, whereas in case of cost accounting, only those expenses which are related with the production of goods or rendering of services are recorded. Now, what are the expenses which are typically not considered in cost accounting? Typical cases are, example number one is bad debts. So let's say you have sold some goods and that customer has not paid you. So this has resulted into bad debts, but this bad debts, or whatever bad debts that you have incurred, pertains to the sale which you have done it in the past. So if I load this bad debts cost on my current products or services, then that will not be the correct costing. And therefore, we don't consider bad debts while doing the costing. But in financial accounting, unless and until you book the bad debts, the customer account will not be knocked off, and therefore bad debts will be recorded in the books of accounts. Similarly, there are certain provisions which are mainly made for accounting closing, or you can say for compliances of accounting standard. So again, those expenses or those provisions are not considered in financial, those are considered in financial accounting, but these are not considered in cost accounting. For example, let's say provision for gratuity. Again, as per the accounting standard, you are required to take the actual valuation of the gratuity payable, and that provision you are required to take into books of accounts as per the accounting standard. But these provisions will not be taken into cost accounting. And third and most important part will be any abnormal or non-recurring expenses. So for example, let's say in a factory, there is a major fire. So whatever loss is there, that will be recorded in the financial books, because unless you record that, your financial books will not be showing the correct, true and fair view. But in case of costing, this will not be considered in costing, because this whatever fire has occurred and whatever expenses that you have incurred, this is a past event. And again, the logic is, if you load this expenses on the current products, or whatever you are running products and services, then again it will give you the distorted picture. The classic case is of COVID. During the COVID, most of the businesses were affected, and whatever losses were incurred during the COVID period were certainly abnormal in nature. Now, the issue is, if you consider these expenses for costing purpose, then your costing will be wrong. And therefore, there are certain expenses which are uh, incurred in financial accounting, or these are booked in financial accounting, but will not be considered in cost accounting. For the simple reason that most of them are past events, or they are in the nature of abnormal and non-recurring. Then next point is only transactions which can be measured in monetary terms are recorded. But in case of cost accounting, even the non-monetary information is used. For example, number of units, hours. So there is a lot of quantitative information which is considered in cost accounting, which may not be, or which is not considered in financial accounting. And it is purely the monetary information which is considered. Then financial accounting deals with the actual figures and facts only. Cost accounting deals with the partly facts and figures and partly estimates and standards. So even in case of costing, there are certain expenses, or there are certain costs again, which will be seeing in the latter part of the presentation, which also will be considered, though these are not recorded in the financial books or financial accounting. Then financial accounting on efficiencies of various workers or plant and machinery. Cost accounts provide valuable information on the efficiency of employees and plant and machinery. So typically in cost accounting, the emphasis is on capacity utilization. Now, when it comes to capacity utilization, just few minutes back, the example which I gave, that that automobile company or that car company is having a demand of 10 cars per day. And if they put the capacity of say 1,000 cars per day, then practically they are not utilizing even 1% of their capacity. Or let us take a revised example. Instead of 10 cars per day, if they put up a capacity of 100 cars per day, then they are not even utilizing 10% of their capacity. But obviously, when they have set up this capacity of 100 cars per day, then obviously there will be a depreciation charge for this entire plant. And this depreciation charge will be loaded on the products that you are manufacturing. So again, how efficiently your plant and machinery is operating or how efficiently your employees are working, those aspects are also considered or covered under cost accounting. Whereas in financial accounting, it is basically only the transaction booking. Then in financial accounting, the stocks are valued at cost or market price, whichever is lower. So in cost accounting, the stocks are always valued at cost only. So again, accounting standard 2, AS2 about the inventory specifies that cost or net realizable value should be adopted for accounting purpose. Whereas in cost accounting, the inventory is always valued at cost only. Then in financial accounting, it is a positive science as it is subject to legal rigidity with regarding to preparation of the financial statements. As you are aware that under Ministry of Corporate Affairs, the formats for balance sheet, profit and loss account are prescribed, and these are irrespective of the industry. So whether you are into construction industry, whether you are in the hospital, whether you are in the hotel, whether you are in manufacturing, whether you are in the chemicals, so irrespective of that, the format of balance sheet and profit and loss account is uniform for all the industries. And because of that, there is a bit rigidity in the reporting. Whereas in case of cost accounting, it is, of course, it's a science, but at the same time, it is normative because it also includes techniques of budgetary control and standard costing. And as you are aware that the costing methods are different for different industry. So for example, for chemical industry, there is a process costing. For contract type of industry, there is a contract costing. Then for uh, so for basically for construction, you have a contract. Then for transport, there is a separate system for transport accounting, cost accounting. So basically, depending upon industry, the method of cost accounting changes. And this gives a bit flexibility because depending upon industry, there are certain concepts which will be industry specific. For example, in case of chemical industry, there is a concept of normal loss, abnormal loss, evaporation losses, and all that. Now, the same concept will not be there for construction. Same concept will not be there for transport industry. So, depending upon the industry, the formats and the controls will change. Then the final point, the accounts are kept in such a way to meet the requirements of Companies Act as per Section 128 of and Income Tax Act Section 44A. So again, under Section 128 and 44A of Income Tax Act, they have specified which books of account should be maintained. Whereas cost accounting are uh, generally kept on a voluntary basis. Of course, for certain industries, it is mandatory, but the formats per se are not specified. So earlier, in cost accounting also, the cost records which are required to be maintained by the company, there were formats which were industry specific. And again, uh, they had to maintain these formats or they had to compile this information in those formats only. And this was bringing a bit of rigidity in overall record maintenance. But this requirement of maintaining the cost records in the specific format for specific industry was done away with, and now the companies are free to maintain the records the way in which they want. The only requirement is whatever is desired finally from the records, you should be in a position to get that information, or you should be in a position to produce that information whenever it is asked for. So that is the only requirement. So basically, it is giving more freedom for cost accounting rather than financial accounting. Right? Yes. Any doubts? Any doubts in this comparison? Okay. Then we'll move ahead to the next part, that is elements of cost. So as you are aware that there are basically three elements of cost: material, labor, and overheads. And again, in material, labor, and overheads, these are further bifurcated into direct and indirect. So direct material, direct labor, direct overheads, and indirect material, indirect labor, and indirect overheads. Then direct material plus direct labor plus direct overheads, this is typically called as prime cost, whereas indirect material, indirect labor, and indirect overheads put together is called as overheads, right? A quick recap of what is direct material, direct labor, and overheads. Direct material is the cost of material which can be attributable to a cost object in an economically feasible way. So typically, wherein there is one-to-one correlation of the raw material and the final product is, or the material which you can directly identify with the final product is called as direct material. For example, again, if you take a car as an example, then uh, if you manufacture any car, then typically 5 tires will be required, then one engine will be required. Likewise, whatever is directly identifiable with the final product and which is present in the final product, these are typically called as direct material. Indirect material is material which cannot be directly attributable for a particular cost object. So again, while manufacturing the car, you will obviously need various chemicals, oils, grease. Likewise, you will need a lot of material, which is of course required for manufacture of that vehicle or for that cost object, but it is not directly attributable for that particular cost object. And therefore, these are treated or these are classified as indirect material. Then direct labor, the employee cost, which can be directly attributable with the cost object in an economical feasible way. These are called as direct labor. So typically, those workers who are directly involved in the production, these are called as direct labors, and indirect labors, which are not directly related with the manufacturing of a particular product or service. Now, typically, this will include the supervisors or the support staff, that is, those who are working in, say, accounts department or, say, HR department. Uh, so, likewise, whatever is the support staff, those are typically your indirect labor. And overheads is, as I said, it is basically your sum total of indirect material, labor, and overheads. So, that makes the overheads. Then when it comes to overheads, then there are three concepts which are very much important. The first concept is the cost allocation. Now, what is cost allocation? When any item of cost which is identifiable directly with the product or department, such costs are charged to such cost centers directly. So, for example, let's say there are, say, production departments and there are service departments. Now, if you take example of salary, now this salary you can identify directly. So how the mechanism works is each person is assigned with a particular department. So let's say uh, in a manufacturing organization, typically, let's say there are 5 or 6 departments. So let's say there is a production department, then there is a maintenance department, then there is a finance department, HR department, and say procurement department. So these are 5 different departments. So each person will be identified with this particular department. And whenever the salary is processed or whenever the salary is paid, this will be allocated to that particular department directly, because you can directly identify this cost with that particular department. So in case of cost allocation, there is no basis which is required for distributing that cost over the departments. These are directly identifiable with that particular department or that particular product. Second is cost apportionment. Now, there are certain costs which are not directly identifiable with the department, and therefore these are required to be distributed over the departments or the products on some suitable basis, or you can say predetermined basis. For example, let's say you are paying a rent for the factory. Now, how much rent should be allocated, or you can say distributed to this department, will be decided by, let's say, the area which is consumed by each department. So let's say your total factory area is, let's say, 1 lakh square feet. Out of that, say 75,000 square feet is consumed by the production department. Say 5,000 square feet is consumed by maintenance department. So likewise, each department, how much area they have consumed or how much area they have occupied, that will be determined, and on that basis this rental expenses will be distributed between these various departments. Similarly, there will be certain other expenses, for example, say printing and stationery. So one way of doing it is, whenever someone wants a printing and stationery, he will have to mention his cost center. And if that cost center is mentioned, then again, it will be identified with the department directly. But in case the, say, printing and stationery or other similar expenses, the volume is not that much. So it will be bifurcated or it will be distributed between the various departments on the basis of, say, for example, manpower. So number of people on the basis of which these expenses will be distributed. So for each head of expense, there will be certain basis which will be determined in advance, and this will be distributed on that ratio, in that ratio, and that is called as cost apportionment, right? Now, once the cost allocation and cost apportionment is done, this is basically called as primary distribution. So all the cost will be first allocated to production as well as service department, or you can say the support department. Post that, there will be a secondary allocation wherein the service department cost, or you can say support uh, function cost, will be reallocated on production department on some suitable basis. So that is called as secondary distribution. So that is how you arrive at the cost of production departments. And the next and the most important step is, whatever cost is incurred by this production department, it is finally absorbed in the products that you are manufacturing. Now, uh, again, if you look at the practical aspect of this, uh, how in practice the costing is done, I'll try to explain it in brief. So as I said, there are these three elements: material, labor, and overheads. Now, as far as material is concerned, let's take an example of a product industry. So for each product, there will be something called as bill of material. Now, what is this bill of material? It is basically a listing of whatever raw material which is required for producing that particular product. So that will be listed in that bill of material. So typically, ERPs like SAP, what happens is, once you confirm that, for example, let's say product A, say 100 quantities manufactured. So in ERP, there are typically two systems which are followed worldwide. One is issue-based accounting, and the second method is called as backflushing. So what is backflushing? So uh, as I said, for example, product A, 100 quantities manufactured. So what system will do for this 100 components, the system will look at the bill of material and it will assume that whatever was required or whatever was listed in the bill of material is consumed. So what it will do is for those 100 material, it will do a backward calculation and 100 quantity multiplied by each item in that bill of material, there will be a backflushing, and that is how the consumption is booked or the material cost is worked out in the system. Now, uh, bill of material typically will give you only the uh, quantitative part of it. As regards the value of that particular raw material, again, there is a concept called as landed cost of raw material. So what is landed cost of material? So basically it is your procurement price plus non-cinematable taxes plus expenses which are directly attributable for purchase of that particular raw material. For example, say transport charges, freight charges, insurance charges. So what is landed cost in short is what is the cost of that particular raw material in the factory. So that is how the value, or you can say the cost of that particular raw material is worked out. So with this combination, that is quantity plus rate of that particular raw material and multiplied by the production, the cost of material is worked out. Similarly, uh, there is a concept called as cycle time, or you can say routing in the ERP system. So again, this is on the basis of predetermined study, which is typically is done by industrial engineers, and they critically analyze the production process or the product which passes through the various activities, and for that they note down the timing for each process in a scientific manner, and that is how these are predetermined in, or these are fixed in the ERP system. So for a particular product, how much will be the working time, or you can say what is the cycle time which is required for each product. And there will be a predetermined rate which will be again loaded in the system, that is called as absorption rate. So firstly, with the help of bill of material and the rates and the production, you get to know the material cost, and then the labor cost and overhead cost is determined on the basis of this cycle time. So this is how typically the costing in general is done in the ERP environment, right? Now, as I said, like cost allocation, cost apportionment, and cost absorption. So finally, whatever overheads that you are incurring, finally absorbing into the product at a predetermined rate is called as cost absorption. So these are basically the three, you can say, activities or sub activities in the overhead allocation. So this is how typically the cost for any product is ascertained. Of course, uh, because of limitation, I won't be in a position to explain it in detail how the actual costing is done, but this is how the process flow is typically. Then similar to this allocation and all that, like as I said, budgetary control and standard costing. The basic objective of budgetary control and standard costing is to have the cost control. For example, with the help of budgetary control and standard cost, you compare the actual, you calculate the variances, and then you analyze these variances, the reasons for these variances. So by cost control, it is regulation by executive action of the cost of operating an undertaking, particularly where such actions is guided by cost accounting. And as against that, because many times we use this cost control and cost reduction as a synonym, but these are not synonyms. There is a difference between cost control and cost reduction. Cost reduction is real and permanent reduction in the unit of cost of goods manufactured or services rendered without impairing their suitability for the use intended. So what does that mean? For example, suppose I'm manufacturing a product and X material is required. Now, uh, I have done some R&D and say 1 kg of X, or you can say 1 kg of copper is required for manufacturing a particular product. Now, with the research and development, I have found that instead of using 1 kg of say copper, I can mix 100 grams of say, for example, stainless steel. Whatever example I'm giving is not that scientific, but just to understand what is cost reduction, I'm giving the example. So instead of 1 kg of copper, if you do the research and development and finally come to the conclusion that instead of 1 kg of copper, if I use 900 grams of copper and plus 1 kg, oh sorry, 100 grams of stainless steel, still the ultimate, you can say the use, intended use of that product or the quality of product is not getting hampered. If that happens, typically copper will obviously have more rate as compared to stainless steel. And therefore, once you start using this, you are saving the cost of that 100 grams of copper, whatever is the differential cost between 100 grams of copper and 100 grams of stainless steel. And thereby, this is a permanent reduction in the cost of a particular product, right? And therefore, thereby you are able to reduce your cost, which is permanent in nature, but without compromising any of your uh, you can say quality of the product or whatever is the final outcome of that particular. So likewise, if you use some alternate material, or let's say typical example will be currently you are importing certain products. Now you have done the research and development, and now you have uh, say developed that product locally. So thereby you have saved a lot of cost of importing the goods. So again, this is a permanent reduction in the cost. One more example is there are certain processes which a product goes through, but because of change in material, it may happen that a particular operation which was required earlier is not required now. So complete elimination of a particular operation itself can be the cost reduction. So there are many such methods, or there are many such ways by which you can achieve the permanent reduction in the cost, and that is what is called as cost reduction. I'll just give you some practical examples. When I was working with Tata Motors, for operators, we had one scheme called as suggestion scheme. So what was that suggestion scheme? That operator was supposed to give the suggestion, and from a finance team, we used to evaluate the impact of that saving, that how much will be the impact of that saving, and equivalent to that saving, the worker or that operator was given certain awards. So sometimes this award used to be in cash, or sometimes it used to be in some gift form. But that was indirectly an incentive that that worker who is actually working on that product very closely and who knows the product better, if he gives any suggestion and if there is a permanent reduction in the cost, then there was an award which was given to that employee or that worker. Okay, so that is what is cost reduction. Yes. Any doubts so far? Yes. Any doubts? Okay. Then we'll move to some more concepts. The first is differential cost. So differential cost is change in the cost due to change in activity from one level to another. So as I said, suppose I have a capacity of say 1,000 products per day. So if I operate it at 10% level, what will be my cost? If I operate it at 20%, what will be my cost? If I operate it at 30%, what will be my cost? So for each increment of 10% of operation, what will be my additional cost? So why this is important? Because whenever you want to plan anything, you can plan basis this differential cost, right? And this will be again helpful for decision making. And uh, there will be typically, as I said at the beginning, there are three types of cost. One is variable, second is fixed, and third will be semi-variable. So what is this semi-variable cost? Semi-variable cost is combination of fixed and variable cost. And till a particular level, it will remain constant, and post that it will be variable, or there could be a combination. For example, let's say your mobile bill, right? If it is postpaid mobile bill, then one part of it is the rental which is charged by the mobile company, which is fixed. So whether you make a single call or not, that rate you will have to pay. And the second part will be based on your number of calls. So one part of the cost will be based on your usage, and second part will be irrespective of your usage, that will be fixed in nature. So that is typically called as semi-variable. So all these decisions or all these facts will come into place when it comes to differential cost. Then second is opportunity cost. In the simple language, opportunity cost is the cost of opportunity lost. So what does that mean? For example, uh, in financial accounting, this concept of opportunity cost is not there, because in financial accounting, just few minutes back, you have seen whatever is actually incurred, only that gets booked. So opportunity cost is something which is not recorded in the books of accounts, but for decision making, we should consider this. So what is opportunity cost? Again, the cost of alternate use of a resource. For example, let's say after doing everything, okay, say for example, in a business, you have invested 10 crore rupees. And after doing everything, you have a profit of say 1 crore rupees. So what is the return on investment? It is 10%. So you have put in 10 crore rupees, you have invested in plant and machinery, you are investing in labor, material, everything. You are managing your inventory. And after all this, you are having a profit of 1 crore rupees, which is only 10%. So what is the opportunity cost? That if I put this 10 crore rupees in, let's say, fixed deposit, the safest, I would say, the investment opportunity, or you can say the least yield earning investment opportunity in the fixed deposit, which is giving me say 6% returns. So without doing anything, by investing 10 crore rupees, I would have got 60 lakh rupees as it is. So what is my real profit? My real profit is only 40 lakh rupees, because if I would have put this 10 crore rupees in fixed deposit without doing anything, I would have got 60 lakh rupees. And now after doing all this, I am getting 1 crore rupees. So effective profit is only 40 lakh rupees. Or let's say if I put this 10 crore rupees in the share market, and the average yield which I'm getting is 15%. So I would have got say 1.5 crores without doing anything. Without doing anything means just by investing in the shares or mutual funds. So in this case, instead of 1.5 crore rupees, if I'm getting say 1 crore rupees as profit, That means, in fact, I am losing 50 lakh rupees. So this is the concept of opportunity cost, right? Then imputed cost. Again, the cost which will not be recorded in the financial books. This is hypothetical or notional cost, which is not actually involving any cash outlay, but it should be considered for decision making. For example, interest on internally generated funds. Many times it happens that whatever funds you have generated in the business, you reinvest those funds in the business itself. Now, if that is the case, then the problem is normally in the financial accounting, we don't consider the interest, or you can say indirectly, the opportunity cost of this internally generated funds, we don't consider in the financial accounting. But for cost accounting or for decision making, we should consider this imputed cost, that is internally generated funds and the interest thereupon. So this is called as imputed cost. Then engineer cost, then typically whenever there is a one-to-one relationship between the input and output, then this is called as engineer cost. And against that, managed cost is when there is no accurate relationship between the input and output, right? So for example, the typical example can be advertisement. So uh, advertisement, whatever you are spending, it is really practically impossible to quantify how much is the impact in my sales, or how far the impact of this advertisement will be there on my product or service. So it is really very difficult to determine this accurately, and therefore these are called as managed cost, right? So this is the difference between engineered cost and managed cost. So uh, these were some basic concepts, and as I said, most of you are cost accountants, so this will be a kind of repetition for you, but at the cost of repetition, since it's a part of your syllabus, uh, I had to take this as was told to me. Now, as I said, though it's not directly in your syllabus, but just to make you aware about some latest concept. Of course, though I'm saying that these are some latest or advanced concept, uh, in say advanced countries, these are nowadays again old concepts, I would say. But yes, in uh, India, still these are you can say latest or advanced concepts. Okay, PPT, I will be sharing it with WRC. I think they will be internally sharing it with you. So I cannot have this individual mail IDs, or so I hope WRC is having the mail IDs of everyone so that they can share it with you. Any other doubts so far? Yes, any doubts so far? Or anything that you would like to know in specific before we move to the next part? Okay. If there is a silence, it implies two things. Either you have understood everything or you have not understood anything. So I'm assuming it is the first one, you have understood everything. Right. So we'll just touch upon some latest concept, I would say, comparatively latest concept, I would say. The first one is activity-based management versus object-based management. Now, activity-based management or activity-based cost management, ABCM or ABC analysis, what we call it as. So this was the concept earlier, or of course, in uh, many companies, it is still a new concept, even the activity-based costing or activity-based management. And in many industries, it is not yet, you can say, fully operational or it is not yet implemented. But activity-based management is again finding out the cost drivers and identifying the cost basis that. So, for example, say uh, there is a warehouse in charge and his salary you want to allocate to the products. So the simple way to allocate his cost is in the traditional costing is based on the say sales. So suppose he is doing say outward logistics support. So whatever sale value is there, basis that his salary will be apportioned. So that is typically in the traditional costing. In the activity-based costing, what is done is rather than allocating it on the basis of sales value, it is allocated on the basis of number of invoices. Because as a storekeeper, his activity driver, or you can say the cost driver, is how much time he is consuming or how much time he is devoting for making one invoice. So it may happen that a particular product is having a sales value of 10 lakh rupees for a single product, and there will be only one invoice. Whereas the other item is having a sales value of 100 rupees and there are 1,000 invoices of that particular product. So in the traditional costing, product A with sales value 10 lakh and product B with sales value of 1 lakh. So the salary of this storekeeper will be apportioned on the basis of the ratio 10 is to 1. So unnecessary, the more load will go to the product A, which is having a sales value of 10 lakhs. But when it comes to activity-based management or activity-based costing, and wherein the cost driver is the number of invoices that he is processing, practically for that 10 lakh rupees product A, he has only single invoice, and for that product B, he has prepared 100 invoices. So now instead of 10 is to 1, the ratio will be 1 is to 100 because more time was spent on that 100 rupees invoice because he had to generate that invoice 100 times, and therefore the related cost, or you can say the proportionate cost, should be apportioned more to the product B having the sale price of 100 rupees. So that is what is activity based management. Now the further step is object based management. Okay, so in object-based management, as I said, activity-based management, the next step is object-based management. So typically, in the object-based management, the objective or there are certain set principles which are prepared by the management, and basis that the entire cost is captured or it is basically the entire orientation is towards that. Then typically object-based management is more advanced stage of say project management, and it gives more accurate results as compared to activity-based management. Then the next concept is total quality management. Now, total quality management, one may feel that this is only related to quality, but as we are aware that uh, basically nowadays customer satisfaction and the quality of the product is of utmost importance. Now, it is like inventory management. So when we say inventory management, too much of inventory will also be a problem because it is unnecessary locking up your working capital. And too less of inventory is also a problem because it gives rise to production stoppage probably, right? So you have to strike a balance between these two. So basically, uh, in case of total quality management, the focus is you detect and reduce the errors in manufacturing. Then uh, the second objective is to streamline the supply chain management. Some of the concepts which we'll be discussing later on are interrelated, and uh, you make sure that your employees are trained enough, and which will result in overall experience, overall improvement in the customer experience. Now, again, just to give you the example of any engineering company, or let's take an example of automobile industry only. Suppose I am a supplier to an automobile industry and my part sale price is only say 100 rupees. But this 100 rupees part is going into the engine of a car. So typically the cost of the engine will be say 1 lakh rupees. Okay, just for the sake of example. Now, my part value is only 100 rupees, but it is going into such a it is going into the engine, and it is at a such a critical you can say operation that if this part fails, my entire engine may fail. So let's take an example that because of the bad quality, this 100 rupees part which I am supplying, because of that, the engine worth 1 lakh rupees has failed. So what that company or what that automobile company is going to do, they will not debit me only for that 100 rupees part which I have supplied. They will debit me for that entire 1 lakh rupees, because what are the consequential damages? The consequential damages of 1 lakh rupees. So they will say that because of your faulty part, my loss is 1 lakh rupees. So whether your part is worth 100 rupees, that I don't bother. So I will debit you for 1 lakh rupees. So such serious consequences will be there, and therefore this total quality management. And why I'm discussing all this concept is, again, this is related with costing only, because if you supply a faulty part and you get a debit for 1 lakh rupees, your entire pricing, your entire costing will go for a toss. Then budgeting was is there for many years, but now in line with activity-based management, activity-based budgeting is also a new concept, because unless and until you have this activity-based budgeting, you will not be in a position to implement your activity-based costing in a proper way. Then profitability analysis again is, I would say, an old concept. Now, customer-wise profitability is what is nowadays uh, looked upon, because suppose there are two customers. For both the customers, I am supplying a material, or let's say product worth rupees 10 lakh. Okay. Now we'll take only one parameter, that for both the customers, my credit period is 60 days. Customer A is paying me exactly on the 60th day, whereas customer B is paying me on, say, 90th day. Now, what is the issue? I have supplied same product with same selling price, with same cost. So if you look at the profit per se, then for both the customers, I am having the same profit. But the issue is, one has paid me on 60th day as per my normal credit period or credit terms, whereas the second customer has paid me on 90th day. So what does that mean? For this additional 30 days, I am required to incur the working capital interest. So only on this one parameter, if you look at now the revised profitability, then customer A is more profitable, right? So there could be several such parameters on the basis of which you will be in a you will have to determine the customer profitability rather than the overall profitability, because overall profitability may give you the distorted picture or wrong picture. Secondly, uh, strategic positioning analysis. So again, the product or service that you are having, how effectively it is strategically positioned, and on that basis, what is going to be your analysis. For example, again, since I was working with Tata Motors, few of my examples are of automobile company or related to that. So, fortunately or unfortunately, I was part of the Nano project also. And when Nano was introduced, it was strategically positioned in the segment in which practically there was no competition. So earlier, or when Nano was introduced, it was expected that it will be introduced at a price of 1 lakh rupees. So again, uh, which market or what exactly what will be your exact strategic position, basis that your pricing decisions and other related decisions will be determined, and basis that you'll have to. So basically, your strategic positioning analysis is something which is very much important. Next is productivity and business process re-engineering. Uh, Many times we manufacture a product in a typical way, and we don't even think that it can be manufactured in some different way. Again, I will quote the nano example over here. I'll just take 2-3 minutes to explain this concept so that everybody will understand this uh, concept. So, uh, and since I was witness of this particular process, I'll just take 2-3 minutes. Uh, when Mr. Ratan Tata had announced that we will come up with a car with 1 lakh rupees, it was not just a emotional statement, or you can say a statement without any calculation. So there was a lot of thought process behind this calculation. So uh, unfortunately, what happened to West Bengal, and that plant had to be shifted, and a lot of issues came up later on, and because of that, overall project was not that successful, but the thinking behind the nano was really very amazing. So many have criticized that just like an auto rickshaw, the nano is having a rear engine, but it had applied the basic physics behind it, or typically you will see that engine for any car will be at the front, whereas in Nano it was a rear engine. So what was the advantage of rear engine? Because in physics, or as per the basic principles of physics, to push something requires lesser energy rather than to pull something. So this was the principle, and that is why the Nano engine was at the rear. Plus, there was a lot of cost reduction, and why this cost reduction was possible? Because of this business process re-engineering. The second thought behind it was, if you have a front engine, then you will find that there is a long exhaust pipe which runs from front side till end of the car. So if you have a rear engine, that cost of that pipe was totally eliminated, right? So likewise, for Nano, there are more than 15 to 20 patents which were registered because of this various business reprocessing in business process reengineering which was done. And there are several examples. So again, if you look at Nano, then on the front you will find that there is only one wiper. Now, having one wiper, the intention was not to reduce the utility. With that single wiper, the basic objective of cleaning the glass was very much there. But the advantage of having single wiper was, single wiper means single wiper plus single wiper motor. If you are having two wipers, that means there will be two wipers plus two wiper motor. So again, cost of one wiper and one wiper motor was reduced, and because of that, the battery required to operate was of lesser, you can say, wattage. So without compromising on the quality, these initiatives were taken, and without, say, compromising on, say, speed. Let's say whatever 800 cc Maruti was able to produce the torque and other technical aspects, this around 650 cc engine was able to do that. And as I said, unfortunately, what happened later on was a very sad story. But the intention, or you can say the thinking behind that, was really very fabulous. Then pricing strategies, uh, as I explained, geo penetration pricing, what they used, and practically they killed the competition. And after that, they started increasing their prices. So likewise, whenever you are introducing any product, so for deciding the pricing strategies, you should know exactly what is your cost and how far you can accommodate, or how far your say margins are going to be with the pricing strategies that you will be adopting. Then life cycle costing, as you are aware that whenever any product is introduced, then introduction, maturity, and declining. These are the three typical phases in the life cycle of a product. And with some efforts, if you can increase the maturity, or you can say stability of that product, then whatever initial investment that you have made, you will be able to recover them in a better manner. So again, typical example in automobile is facelifting of a vehicle. So what is facelifting of vehicle? They just change some exteriors without changing, say, engine and other things. So with some modifications, they relaunch the product as if it is a new product, or comparatively a new product or new model. So with that, they are in the position to utilize their capacities in a better way, and whatever initial investment that they have made in a better way. Then target costing. Again, here I would like to give nano example. 1 lakh rupees was the selling price which was decided. So obviously there was a target cost which was decided in order to have some profit out of it. So what is target cost? So you first, uh, you can say, decide the cost which you can afford, and then you try to fit in that particular cost, again without compromising on the quality, with the help of, say, business process reengineering and other techniques. Kaizen costing, again, it's a Japanese concept, you may be aware. Kaizen, the basic principle is you take baby steps. So whenever you want to improve something, rather than taking some bigger decision, you take a very small decisions, and with small decisions or small steps, you try to improve upon the quality and other things. Value chain analysis. In any business, there are many non-value added activities. So the first uh, activity is basically identify the value chain in your businesses, and for each value chain, how much, or each value chain, how much it is bringing a contribution for you. And in case there is no, or if a particular value chain is not really, say, value added, that those activities you can eliminate. Just in time is again inventory management technique, wherein without investing much in the inventory, you make sure that you will get the product in time, so that there will be a minimum or zero inventory, right? So just in time is relatively an old concept. The latest concept is just in sequence inventory. Again, I will give the example of Tata Motors only. When I was working with Tata Motors, we used to procure seats, car seats from Tata Johnson. That time it was Tata Johnson. So every day or rather a day before, we used to give them the production plan. And it was not only just in time, but they used to supply the seeds in the same sequence in which we are going to have the production. So practically, you are aware that when it comes to seeds, then depending upon the car, so let's say at that time, Indica and Indigo were the major two products. So within Indica also, there were five different variants. So depending upon variant, the seed quality used to change. Uh, so let's say the first car is Indica base variant. After that, Indica top variant. After that, Indigo base variant. Then after that, Indigo top variant. Likewise, the production cycle used to be. And Tata Johnson used to supply the seeds exactly in the same sequence so that worker, he was not supposed to apply his mind that whether the seat is matching with the model which is in front of him or the make and model which is in front of him. So he was supposed to only pick that seat and fix it in the car. And believe me, there is to be zero defects, or you will, there is to be zero, you can say, mismatches in the seats which were supplied and the car which was manufactured. So, never it happened that for base variant the top end seat was fixed, right? So, again, this is just in sequence inventory management. Then responsibility accounting, we have seen the responsibility center. So responsibility accounting, also called as strategic business units. So wherein for the complete activity, they are responsible. So right from the cost, profits, capacity utilization, manpower, everything, they are responsible. Then performance management, again, similar to responsibility accounting, the performance management is again that particular unit is responsible for overall performance of that particular unit. Then product life cycle. Uh, Product life cycle is again, uh, if you typically consider a particular product, then that product also comes with some of the products, of course, comes with what is called as warranty. Right. So even if you take again the example of a car, then car will come with some warranty. And therefore, whenever you are estimating your cost or whenever you are deciding your sale price, you should not only consider up to the production point or up to the sale point. You should also consider, or you should also take into account the warranty cost which you have built or which you are you are offering to the customer, and that also you should consider in your costing. Uh, Cost to serve activities. Now, again, because of new concepts, these are the you can say with the advanced techniques or advanced data management. These are the techniques, or you can say these are the uh, you can say the activities which are very much required in order to take the decision. Cost to serve activities is again for each customer, how much I am incurring to serve that particular customer. For example, uh, the classic example is of the cloud kitchens that we are having. So in the old days, when I'm saying old days, not very old days, even say 5 years back, if you want to set up a hotel, then what is minimum, say 1,000 to 2,000 square feet minimum area. Then you will have a kitchen, then you will have a table, chairs, and everything. And uh, plus the serving cost, that is the waiters and everything. Now, because of this new apps like Swiggy, Zomato, and all that, you may be aware that there are shared kitchens which are used by three, four, five various uh, service providers, or you can say the uh, production people, and they don't have any serving place. So 100% deliveries are through this Zomato, Swiggy, and similar apps only. So what is the advantage? There is a substantial saving in the serving cost. So there is no space which is required. There are no waiters which are required. There are no cutlery which is required. Nothing is required. Water is not required. Then say housekeeping is not required. So a lot of cost has been saved. So compared to all this, let's say if I put a hotel and if I make a turnover of say 1 crore in a year, but out of that I'm having say 20% profit, that is 20 lakh rupees. So I'm effectively having 20 lakh rupees as the profit. Now instead of having full-fledged hotel, let's say I have started this cloud kitchen concept, and instead of 1 crore, it may be possible that I am having turnover of only 50 lakh rupees. But there is a possibility that because of the reduced overheads, with this 50 lakh rupees of turnover, I may be having a profit of 25 lakh rupees. So ultimately, my top line can be a different, but my bottom line can be much more than setting up a total hotel. So cost to serve activities is something that you need to consider. Then channel profitability. Channel profitability, again, the classic example is of e-commerce platforms. So again, olden days, whenever you want to sell anything, what was required? A chain, or you can say the supply chain, that is distributor, wholesaler, retailer, and all that. Now you simply put your product, or you can you don't need any warehouse, you don't need any retailer and all that. So simply sitting in your house also, your house itself can be your warehouse, and you can simply put your products or products on the website like Amazon and similar websites, and you can use this platform for selling your products. Of course, for certain products, Amazon has their warehouses, and you'll have to sorry, pay the warehouse rent, but you don't have to buy any warehouse, or you don't have to take any warehouse on rent, and that is how the channel profitability can be assessed. So again, the same example of that cloud kitchen versus restaurant, the same logic or the same example can be applied to this channel profitability also. That if I realize that having this entire setup of having own warehouse, setting up distributor, wholesaler, and all that, if I eliminate this and if I take a decision that henceforth I will be only launching my products on these e-portals, then there is a possibility that I will be making more profits in that. Then capacity planning, the example of Mercedes which I gave, that slowly when they got the confidence, they accordingly they start building their capacities. So they it was not the case that on the day one when they entered the India market, they set up their entire full-fledged say uh, plant and they started the operations. Now, the same thing happened for Ford to some extent. That, of course, there were other reasons also, but they could not succeed in the Indian market. So, but Mercedes is really doing really well, despite of being in the luxury or premium segment. And of course, other things are equally applicable, but that is mainly for because of their proper capacity planning. And the last concept is the predictive modeling. Now, you may be aware that there are many simulation models which are available, and with simulation model, you can predict, or you can say uh, you can. There are many simulation models which are available, wherein you can assess that in which market segment, if you put your say product, or then what will be your profitability and all that. So this kind of predictive modeling, and it is backed up by say market research also. So with all this, you can uh, do the predictive modeling, and basis that you can decide whether to launch your product or where to launch the product, what should be the pricing and everything. So and of course, nowadays with this big data analysis and with the help of artificial intelligence and similar tools, you are in a position to take better decisions rather than actually launching the project. So you can say virtually you can launch your product or service and you can assess what is your going to be your overall profitability. So that's it from my side. If you have any questions, I'll be more than happy to take up those. Yes, any doubts? Okay. Concept of object-based. Okay. So basically, object-based management is like the management first decides what are their objects or basically what are their controlling points. For example, let's say if I take a hospital, then in hospital, what I'll do is I will make clear what are my objects. So let's say my object is to assess the profitability of each department. That can be my object. So for example, right from my operation theater, then ICU, then my laboratory, then my X-ray machine. So all this can be the independent departments, and I want to assess the performance or what is my objective? My objective is to assess the performance of this individual units, or you can say individual divisions, or you can say individual units, whatever you call it as. So that you have to first decide, and based on that, you will have to design your system. So uh, in the current system, it may be possible that these expenses are not separately booked. So once you have this objective in your mind that I need to have, or these are my, you can say the objects, and for these objects, I want to assess their profitability. Accordingly, you should plan and you should design your costing system in such a way that you will get the costing, or you can say the profitability for the object that you want. Similarly, say object can be your location. So for example, let's say if I got say different plants, then different plants can be the first set of objective. Then within plant, if I got say separate lines for different products, then again those could be my secondary objectives. So again, so basically object-based costing is you decide as to what you want to be the controlling unit, or what you want to be the analysis point, and accordingly you set up your system so that you get the desired results. Any other doubts?
Hello. Hello, sir.
Yes.
Sir, activity-based budget used in industry nowadays. Can you explain?
Activity-based budget.
Yes, used in industry.
Yes, yes. So as I
Explain,
said,
please explain.
those companies who want to actually implement activity-based costing, the first step ideally is you should have the activity based budget in place, so that whenever the actual activity based costing is implemented, you can compare the results with reference to the budget, and then you can find out the variance, and then you can analyze it further. Somebody has raised the hand, but I'm not in the position. Okay. Villas. Okay. Yes, sir.
Yeah, yes, sir. I would like to know it has been miss out the activity based costing.
No, I did
Hello.
explain, no? See,
Hi.
activity-based costing, the
Yeah.
example which I gave, that say that warehouse person. So traditionally, what we do is that's his salary. In the traditional costing, we allocate it on the basis of the invoice value of a product. So that example which I give, that say there are two products. A product is having a single invoice and with invoice value of 10 lakhs. Whereas there is a product B having sale value of 100 and there are 100 invoices. So obviously to make 100 invoices, that warehouse person will require more time. But in the traditional costing, we allocate it on the basis of invoice value. So in that case, between product A and B in traditional costing, what will happen is product A, the sale value is 10 lakhs. Product B, the sale value is 1 lakh. So the ratio will be 10 is to 1. So his salary will be apportioned on in the ratio 10 is to 1. But the fact is, what is the cost driver? The cost driver in this case is the amount of time he is spending on actually preparing the invoices. Now, in case of product A, he has only prepared one invoice. So let's say, and against that, for product B, he has prepared 100 invoices. So under activity-based costing, the same salary will be allocated in the ratio of 1 is to 100. So let's say his salary is say 1 lakh rupees. So in the earlier case, it was exactly other way around. So product A, for which he required only say 10 minutes, but just because his its invoice value is more, the charge of his salary was more to product A. But in reality, when you actually implement activity-based costing, you will realize that for product B, the proportionate salary should have been charged more. So that is the difference between traditional cost apportionment and activity-based apportionment. Is that
Okay,
clear?
thank you, sir.
Okay.
Yes, sir. Yes, sir.
Yes. Any other doubt? Yes. Any other doubt? Okay. I hope there was some value addition with this session. And as I said, uh, the second part was actually not directly from your syllabus, but looking at the audience, I thought that I should just touch upon those concepts also because those are more practical and latest concept, I would say, and which are used by the industries nowadays. So thank you, WRC, for giving this opportunity, and thank you, audience, for your patient listening and making this session interactive. Thank you.
Thank you, sir. On
Thank you.
behalf of the Institute of Cost Accountants of India, Western India Regional Council, I thank CM Amit Shahane, sir, for his valuable time and knowledgeable session. Thank you so much, sir. So now we'll conclude the session over here. Thank you so much,
Yes,
sir.
thank you. Thank you. Good night. Bye.
Thank you, everyone.